Welcome to The Riff, where writer and investor Byrne Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
How should we think about a cult stock like Tesla and Palantir?
Yeah, so cult stocks are a really interesting phenomenon because the stocks they're usually really abstract. Like, you don't have to know that someone else owns a stock. If you're the typical shareholder of any company, you're an indirect shareholder. It's either like you have an index fund, or there is, you might be an employee, a government employee who has a pension fund and they hold stock for you. And even in that case, they hold the stock through their own investments, like through the indexes they buy or through hedge funds they invest in, et cetera. So you wouldn't really expect people to treat stock ownership as an affinity group kind of thing, especially because it's so easy to move in and out of shareholder status. And yet there is a set of companies where their shareholders kind of know each other. They sort of congregate online. And if they're doing that, they're not doing that to say this company is a reasonably priced stock and the current price makes a lot of sense. Like, they're usually doing that because they're all really bullish and they're going to egg each other on and get more bullish. And I think there's a classic dynamic in any group that has some ideology where the group is constantly shifting to the more extreme version of that ideology, because you can always sort of purity test someone who is not completely on board. And meanwhile, there's this happens especially online. There's a thing that happens when there's a group of people who all strongly believe in something, and there are critics who are just aware of these people, think they're ridiculous, where the critics will quote things, like quote the most extreme things that members of this group say, treat that as representative. And then what you'll sometimes see is that people will actually just turn around and say, yeah, I actually do believe that. So this happened, you can see this happening a lot with crypto, where people would say things like, I sold all my other assets. Like, I'm all in on Bitcoin. That's the only thing I will own. And it's the only thing anyone should own as a financial asset. And depending on when they did that, that may or may not have worked out for them. But with cult stocks, there's a different dynamic, because these are actual companies, they are actual organizations, and it must just be kind of weird to work at a company like this, like at Palantir or Tesla, where that a lot of the shareholders of this company think that you are like a demigod because you work at this firm. And to you, it is probably, a job. And I'm sure most of the people working at Tesla and Palantir, they're there for a reason. They have other opportunities. And so they do probably believe in the company mission and believe it's a good company. But I think like the median retail investor who owns those stocks directly is probably more bullish on the company than the median person who actually works at that company. And over time, it usually does not work out. Like, usually cult stocks, whether it's an institutional cult stock, the old line, you can never be fired for buying IBM, which, like, as far as I know, no one's been able to figure out if the first people to say that were finance people or were people who were making purchasing decisions for big companies. But either way, there was a long period where that was true. IBM was the default company you would work with if you were a large business and needed to computerize something. And it was also the default stock you would own if you were an investor and you were looking for growth. But usually when there's a dynamic like that, like, you have two problems. One is the investors who get really fanatical about companies are pretty valuation insensitive. A lot of times they will back into their view on fundamentals based on what they think the company will do. Or sorry, they'll back into their view of fundamentals based on what they think the right share price would be. And 10x the current price is usually a number people will anchor on when they're doing that exercise. And then the other problem is companies, they do have some obligation to do what's right for their shareholders. And if your stock is overpriced, the right thing for your shareholders is to sell them more stock. And that is, you are soaking the people who believe in your business and buy into the stock. But what you're also doing is, let's say there's a business where fundamentally, like, an intelligent, informed outside buyer would pay $1 billion for this company, and the market cap of the company is $10 billion. If they issue $1 billion worth of stock, They're now worth $11 billion, but instead of being 10x the fair price, they now have $1 billion in cash and then the actual business. So now they're only 5.5-fold overpriced. So those companies do, I think, have some obligation to issue stock and, like basically take advantage of the gap between what their strongest believers think of the value of the company and what the actual value of that company is. And to the extent that people believe in these companies because they also like the mission, that also means that it basically means that owning this company is a sort of indirect way to combine investing with a lower rate of return, but also making a sort of charitable contribution to a cause that you believe in. So back when Tesla was like more politically clear cut as this is the company you invest in because they're eliminating a very large source of pollution and moving us off of hydrocarbons over time. Like at that time, you could sort of say, I don't actually think Tesla will outperform the other stocks in the S&P 500, but I do think that I would rather earn 8% and feel really good about what my money is doing than earn 10% and be morally indifferent or think that maybe the average big company is not so good. If you're investing in an index fund 10 years ago, you're putting a lot of money into internal combustion engine manufacturers, a lot of money into oil companies. So maybe you do feel like the haircut on returns that you would get from someone like Tesla is a good deal. So it is sort of like the retail version of one version of ESG, and there are really two versions. Like ESG is this weird thing where there are two investment cases for it. One of which is accept a lower rate of return because you're investing in companies that are doing good things. You are starving the externality producing companies of capital, so that's why you do ESG. And the other version, which caught on a lot more, was no, actually, the companies that can check off, they can tick every box in the ESG checklist. They are, in fact, better companies. They will get you better returns over time. So you actually have a fiduciary duty to invest in these companies. And neither argument was all that coherent. Like the expected returns argument was actually a really bad one because another way to frame that is ESG is a way to describe the moral obligation that you have to ensure that coal and tobacco have really, really high returns for investors because you're not going to invest in them, so their stocks will go down. And stock goes down is the same thing as expected return goes up. Over, holding a lot of things constant, but in this case, we'll hold them constant. So that version didn't work too well. But the other one, it was imagining a weird market efficiency that there wasn't any reason to think would exist, which is that companies that people would feel really good about investing, they wouldn't feel really good enough. And they should be even more enthusiastic about these companies doing fairly politically popular things, or at least things that are politically popular among college-educated, high-net-worth adults who pay attention to their finances and pay attention to the news and have strong, informed views on various policy issues. So I don't think either of those arguments really held much water. And you can be kind of contextually ESG, where you might say, like, I'm going to invest in the most environmentally friendly company in an environmentally unfriendly business, in part because I think everyone's going to get regulated. These people are already acting as if they would be regulated. And so they get damaged the least, and their competitors are all dealing with these new rules instead of trying to expand their business. So that is more like a situational ESG thing. But you could also do the opposite and say that, look, a lot of this stuff is a distraction for management, and when management's getting paid on complying with ESG mandates, then their compensation is less sensitive to what they're doing for shareholders. So maybe we want to bet against them. It did turn out that like a lot of ESG criteria did correlate with good returns over the period where ESG was getting popular. But a lot of that was that if you looked at those, if you looked at those checklists, you ended up investing in a lot of asset light companies because if they don't own factories, they don't pollute very much. If they mostly sell software, then you just have less pollution. And if they're mostly located in the Bay Area or in big coastal cities, then they are going to offer more benefits to employees, and they are probably going to cater to the political sensibilities of people in those places. So it did backtest nicely, but I don't think there was actually much there. So I think cult stocks for the average investor end up being ESG, but a little bit worse. And so be cautious, even though the companies in question are genuinely cool. And so if you invest in one of those companies and you join the sort of cult of Tesla or cult of Palantir, you should do it thinking to yourself that you are accepting higher volatility and probably lower returns, but you feel really good about what your money is backing.
Yeah. I have related idea to this, which is there's this project called Data Door, which is a community of open door fanatics who basically discuss the open door business and the stock and try to get some wisdom of the crowds. And I have this entrepreneur I know who's trying to do that, but for every like big stock that has a sort of, cult audience around, to create like a wisdom of the crowds community for it. And I'm curious if you think that's a business. If you were able to create communities for every stock where people debate, share insight, like one, I guess you have to believe that there's some wisdom of the crowds there that like helps people get, make better decisions based on that. And two, so one, that you create some value, and two, that you could capture some value. And, people have tried kind of like sort of these social networks around stocks. There's Public, where you can share what you're investing in, share your book, almost like fantasy in investing. There's Stock Twits, which has been around forever, just sort of like worse FinTwit, not to put it down too much. There's Value Investing Club. Yeah, I'm curious what you think of this space more broadly.
Yeah, I mean, it's a business that's been around for a really long time. Yahoo Finance and the Raging Bull message boards were mid to late 90s phenomena, and they were really big. And I think part of what makes it hard is that it's a social network, but people are connecting through shared interests, but the network is tied to that specific interest and doesn't really evolve into a network of people. So at least if you organize it on a stock by stock basis. So in the Yahoo Finance message boards, you would see some of the same people across multiple message boards, especially if you were interested in the same kinds of stocks. So if you were looking at tech message boards, you'd probably find the same day trader in a bunch of the, in the Yahoo message board and the Scient and Viant message board, etc. If you were a value person, then probably the person who's in the Berkshire message board is also commenting on the latest thing that's published in Value Investors Club. So like you do end up with some relationships with these people, but if you have a social network that's tied to a specific interest, and interest in that interest is also volatile, it's also a function of the price, then that social network has this naturally high churn rate. So there are actually subreddits devoted to individual stocks, and it's really, really grim to look at those subreddits when the stocks have an inevitable drawdown. Like the SMCI stock subreddit it's not a happy place right now. Supermicro had an incredible run. I think the stock was in the 20s a couple of years ago, hit like 1,000, and then has subsequently dropped. I probably have those numbers slightly wrong, but it was a crazy, crazy ride. Yeah, so it was 2020 in the low 20s in early 2020. Did hit a peak of about 1,100, or a peak of 1,200, and is now down by more than half from that peak. So if you have a community that is built around, let's just discuss SMCI, then when SMCI drops, a lot of your users just quit in disgust. And maybe you keep that community going because there's a new hot stock to go after. But if your community is all built around the highest, like the most talked about and talk aboutable stocks, then it is pretty much a bull market thing. Like there will be a time, it's very, very rare for retail investors to just massively go short. And so they will just be a lot less enthusiastic about chatting with their friends when stocks are down. So I think if I were thinking of social networks to try to create, that would be among the hardest ones because of that problem, because the intrinsic interest in your social network is tied to external factors you have no control over. And if you compare that to something like LinkedIn, there is churn. You might retire and then you won't be checking LinkedIn very much. For Facebook, there's actually this interesting thing where in some ways, this was definitely not on Mark Zuckerberg's mind when he wrote the initial code. He was not, I don't think he was thinking about just the life cycle that people have. And he did view Facebook as like one cool project among many. But it does turn out that social networks are really, really useful when you have lots of loose ties. Like you have moved as an adult, you've had different friend groups in different places. You're just not going to be keeping in touch with everyone. And you kind of want to know, like, you don't want to randomly remember someone you used to be close to, text them, and then find out that their life has completely changed and now they're living somewhere else and married and they have kids, everything's different. You track all that stuff pretty straightforwardly on Facebook. So your intrinsic desire to engage with that site tends to rise, I would say like it's in some ways very high in your teens and 20s, but in some ways a lot higher in your 30s. Like there are a lot more mandatory updates in your 30s and a lot more milestones that you show with your large collection of very loose ties. So that that's a case where there is this natural tailwind to engagement. There's a natural reason to stick around for a long time. And I think the other way to frame the question of like, can you create these communities around individual stocks would be to ask what went wrong with those other communities. Like I think Yahoo shut down the Yahoo Finance message boards a while back. It was a long while ago now. I don't know that Raging Bull really exists. Value Investors Club does exist, and it's a surprisingly durable social network. But it's less of a community around a stock and more community around a pitch. And I think those are different things. So if there's a pitch, you kind of want people to poke some holes in your idea, to consider some alternatives, to say, okay, if this one's cheap, why don't you buy their competitor who's even cheaper, et cetera. And so that's helpful. It's also, so there's something I've noticed about online communities, which is if you have a field where you can measure people's results pretty reliably, you can see who's telling the truth and who's lying, but people aren't competing just within that group. Like they're competing to be excellent, but they're not competing to be the most excellent person in that group as much. That ends up being a pretty pro-social way to set things up. So you do see that with Value Investors Club message boards. Like people are trying to get really high returns, and you don't improve your returns if you are just like ruthless and vicious in blowing off everyone who brings up valid criticisms of your investing ideas. But it also shows up in fitness related forums. They just tend to have a pretty positive vibe. If they're hostile, it's like performatively hostile. And in various gaming communities that are not about multiplayer games, not really about trash talking, there is like a general pursuit of excellence, and people tend to set some high standard and then try to drag other people up to that standard. So it is like, it does have the recipe for a pretty pro-social community, but you might have to ask, do people actually want pro-social communities? Is that what they opt into? And is that what keeps them engaged? I think for some people, yes. And certainly if someone is committed to whatever form of self-improvement it is, whether it's getting really, really good at real-time strategy games, or it's, hitting a new personal record on the deadlift, or it is really, really understanding what it is that drives Visa's earnings beats and earnings misses over time, you would probably attract those people, but that is a limited audience. Like if everyone were really interested in self-improvement, and if self-improvement were really possible, we'd all be a whole lot better.
Yeah, it is interesting. I do want, with all the conversation that's on Twitter and Reddit, and just, how many people, make financial decisions based on this information, it does feel like a vertical social network should be possible at some point. And it'd be interesting to see if the next few years, like, will there be one that actually has some momentum, or is it actually best just scattered across incumbents because they're, either they do a good enough job, or there are some structural reasons that it's like challenging to build a network here.
I think another piece of it is that if you have a community, you're talking about stocks and you're talking about the fundamentals, you're not just, posting memes. One of the problems is that the turnaround time on those discussions is actually going to be pretty slow. So if you are talking about some company, you really love the business, and someone says, okay, but what do you think about this issue that is going to slowly reduce their gross margins over the next couple of years? To really address that question, you have to have a financial model, and then you have to update it, and then you have to, post the screenshots, say what this does to your discounted cash flow valuation, et cetera. It's just a lot of work, and it is a whole lot easier to just be able to reflexively respond. And so I think that is another feature that social networks kind of care about, is like, what is the turnaround time between when you decide you want to interact with someone through that network and when you can actually do it. And they are trying to relentlessly, shrink that amount of time and also give you more reasons to have those interactions. So if you think about the existence of the like button and then the emoji reacts, the spectrum of emoji reacts, one of the purposes of that is that it is faster to just mash the like button than to type out, I like this. And it's certainly faster to just pick which of these 5 feelings does this post most prompt in my mind than it is to write about your emotional response to this status update. So they are trying to just reduce the amount of time, the amount of thought that it takes to produce a response. And if that's the game that they're playing, and if that's the way to optimize for high engagement over time, then it's a lot harder to compete. It's a lot harder to play that game if the natural interaction is, I'm going to take what you said, I'm going to do a bunch of research and reading, I'm going to do some deep thinking, and then I will come back to you. at that point, the conversation has stopped until the person who's contributing the most can show up again. And so it's hard to keep things as lively as it would otherwise be, which probably, you can, I guess you see this on Reddit, that there are communities that are dedicated to doing detailed fundamental analysis, but they're just a lot less active than the communities that are dedicated to memes, day trading, short-term stuff, conspiracy theories about Citadel, etc.
Hey everybody, Erik here with a word from our sponsors. Fast forward to the end of 2024. Think about your goals. What can you do right now to give yourself the best chance of succeeding? If learning a new language is on your list, you absolutely need to check out Babbel. Babbel offers a range of learning tools, self-study app lessons, live classes, and even podcasts, which have always been my favorite way to learn. Studies from Yale, Michigan State University, and others continue to prove Babbel is better. One study found that using Babbel for 15 hours is equivalent to a full semester at college. Babbel isn't just a game to kill time and make you feel like you're learning a language. It's not overly academic or rigid either. It's all about learning language for the real world. Babbel stands out because it's designed by real people using a modern conversational teaching approach. It's not always easy, nothing worth doing ever is, but it's straightforward and designed to help you start speaking in just 3 weeks. With Babbel, I was able to brush up on my intermediate Spanish to ramp up for travel to Argentina last year, and was able to set clear goals based on how much time each week I wanted to practice. Join millions of Babbel language learners across all age groups. Here's a special limited time offer for our listeners. Right now, get up to 60% off your Babbel subscription, but only for our listeners, at babbel.com/zen. Get up to 60% off at babbel.com/zen, spelled BABBEL.com/zen. Rules and restrictions may apply. The tech world turns to the Brave browser for its unbeatable privacy protections. But did you know that Brave also has a private ad platform? Brave Ads offers first-party targeting, and it's been cookieless since day one, so you can relax while third-party tracking cookies disappear from the web. Today, millions of people turn to ad blockers to avoid being tracked and pestered online. But Brave's new ad model aligns incentives for users and advertisers. Users earn rewards for viewing ads, which they can save, spend, or pass along to their favorite creators. And advertisers score points for respecting user privacy, generating ROI without invasive tracking. So whether it's high-impact announcements on the new tab page or keyword-targeted ads in Brave Search offers diverse, private, future-proof ad formats for all your business goals. Join the future of advertising at brave.com/ads. Mention Turpentine to get 25% off your first campaign.
I want to segue into another post you wrote about where you talked about how minimum ticket sizes in financial products affect where research gets done. When you unpack that idea.
Yeah, so this is a fun one because it is a very technical question. So if you are trying to create a market, like a centralized way for people to buy and sell from one another, one of the decisions you have to make is, what are the increments in which people can post prices? Because if you don't do that, then your computer system has to accept numbers of arbitrary precision, and it's just really annoying, and it's kind of pointless after a while, but you don't know what that while is. And so everyone pretty much chooses some arbitrary increment. In crypto, the tick size is typically very small. There are other asset classes where the tick size is kind of large. Different exchanges in different countries set different minimum tick sizes. And in the US, it used to be that the minimum tick size for stocks was 8s. So if you read older news stories like like early 90s and earlier news stories, when they're talking about the stock market, they will say things like Microsoft closed up 2 5/8 yesterday on, better earnings or whatever. And that actually, from what I understand, dates back to the convention of taking Spanish dollar coins and splitting them into 8s. So that's where we get pieces of 8. That is the same convention that we brought over to stocks. And then in, I believe, 1997, we got finer grained tick sizes. They were being quoted in 16ths. And then shortly thereafter, the New York Stock Exchange decimalized. So quoting in dollars and cents, which is now what we're all used to thinking in terms of. And in a lot of cases, it's not an incredibly material difference for the average investor, but there is an interesting effect. So the smaller the tick size is, the larger the tick size is, the more market makers are competing on latency rather than on more accurate pricing, because the only way to win if the organic gap between the bid and ask is like a 0.01% gap, but the minimum tick size means it can only be a 0.05% gap, the way you win is being the first person to update to the next penny spread. And that has led to a market that's a lot more instantly responsive to every little piece of news and every little change in supply and demand. But it is also, it's an arms race. There's, you can debate over the exact social utility, but it doesn't seem that incredibly useful. If you have like smaller increments in which stocks can be quoted, then it does make sense for liquidity providers to provide more fine-grained liquidity. And this actually creates a very interesting setup where if the bid-ask spread is fixed at a wide level, the payoff from doing a lot of research into a company actually goes down because it's expensive to trade. And when the bid-ask is wide, it also means that people are not providing as much liquidity as they would if there were a narrower bid-ask spread, if it were set more based on actual supply and demand. And what that means is that when you have wide spreads, there's actually incentive for brokers to publish research that encourages people to trade. So they want to publish the research that makes you say this company is trading at $4.25 and it's actually worth $6. And even though the transaction cost of getting into this trade is high, yeah, I'll make almost 50%, so I might as well do it. As the bid-ask spread narrows, it actually makes more sense to do your research privately and just trade on it aggressively and monetize the research that way. So those are kind of policy decisions. You can think of them as pretty morally neutral because in the end, people are going to trade. Different people are going to be more or less sophisticated when they trade. And it's not necessarily a better world if you have a strong financial incentive for brokers to produce research in order to encourage more trading, because the research they produce has multiple economic incentives. And one of those incentives is researchers, sell-side researchers, so the people who are publishing on large companies and saying it's a buy and here's my price target, they do have an incentive to be right. They do have an incentive to pick stocks well. But in practice, the main incentive to pick stocks well is that you make a whole lot more money if you are an analyst or portfolio manager at a hedge fund, doing the same analysis, making the same picks, but now your firm gets 20% or usually less, but sometimes 20% of the upside. And so they can afford to pay you a really nice bonus. Whereas if you were the first person to upgrade, I don't know, if you're the first person to upgrade Meta a couple of years ago when it was trading under 100 and you say like, it is ridiculous for this stock to be this cheap, you're hiring Mark Zuckerberg at a very, very affordable price, and there are a lot of temporary headwinds, and he's not going to waste all the company's money on the metaverse, etc. If you're the first person to make that call, like, yes, you do have an improvement to your reputation. Yes, there will be firms that want to trade through your brokerage, the brokerage you work for, because you had that really good call. They want to have a good relationship with that firm so that if they have questions on your next report, they can ask you about them. So there is an economic connection there, but it's a little bit weak. And meanwhile, another part of the job of sell-side analysts is actually to make it easier for company management to meet with investors. So they are sort of the middlemen in that transaction where company management or investors want to talk to company management. Company management is maybe, they kind of want to know what investors are thinking. They probably are not really, really concerned with making hedge funds as happy as possible all the time. But those hedge funds provide a lot of commission income. So brokers have a really strong incentive to get hedge funds in the room with management when it's possible. And in that model, the sell-side analyst's job is partly to make management look good. It's partly to take what management is saying and explain what their reasoning is, why their strategy is what it is, why they think it'll work, etc. And it's just, for them, there's a much stronger economic incentive to be very positive about a company than very negative. And so if you have, and institutional investors definitely understand this dynamic, they understand it very well, and they recognize that the research that they read from the sell side is not just the product of people trying to make the best possible stock picks they can, even though they do want to make good stock picks, that it is also, there are just other economic incentives at work. The average client, like retail client of a broker who can give them access to these research reports, that retail client just may not have as much of an understanding that this analyst is really bullish on this company, in part because this company's management is going to be going to some conferences and they're less likely to go to the conference put on by this broker if the broker puts a sell on their stock. So when you have wider spreads like that, it does encourage the publication of more research, but it also means that more of that research is going to get consumed by people who are not putting it in its full context and may end up making suboptimal decisions.
Yeah, that's well articulated. Let's segue to something you wrote about as it relates to India kind of surpassing China in terms of the major market cap index, even though China has almost 5x the GDP.
Yeah, it's weird, isn't it? So people will sometimes produce charts of stock market capitalization versus GDP, either worldwide or for particular countries. And to some extent, it is a useful indicator. We call it the Buffett indicator sometimes because Buffett did a chart of this in 1999 and said stocks are getting pretty overpriced based on this. And I don't know when they'll go down, but they will not have great returns in the near future. And then almost immediately, within 8 months, tech stocks started going down, and they indeed did not have a great 10 years after that. So in fact, if you go 10 years after that, you get to 2009. So yeah, very, very good call, very good market timing. But the ratio of market cap to GDP is the result of a couple other things. For example, US companies are pretty global in a way that many other countries' biggest companies are not. And so when you look at that market cap, you are looking at, look at someone like Facebook or Google, like a lot of their revenue is overseas. So US GDP is not the proper denominator for that fraction in the same way that it would have been in a less globalized economy. So that's one piece. But the other piece is different countries just structure their financial systems in different ways. And actually, the global default is to have a mostly bank-centric system where a lot of companies they grow because they have internal capital, like they are producing cash flow, they reinvest it in their business. That's how they grow. If they need more capital, they typically get it from banks, and they just are less likely to IPO. And if they go public, they are less likely to pay out a dividend or buy back stock or otherwise keep their investors happy. It's just not the main source of capital for them, and so they don't have to worry that much about capital markets. But the U.S. and really former members of the British Empire tend to have a very capital markets focused financial system, where companies raise money. If they borrow, they borrow with bonds, not just bank loans. And they also raise money in equity markets. And what that produces is two things. One thing it produces is just a much more flexible capital system, especially for high risk, high growth companies. So one reason that the US gets a lot of high skilled immigration and has a lot of companies founded by immigrants from outside the US is that it's just really hard if you are in, say, Germany, really, really hard to get venture capital. And even if you get venture capital, the returns that you get from going public are also just not that great. The stocks just don't get the same valuation that they would in the US. And your employees are just less likely to be excited about stock options. If you're not familiar with the stock market, stock options absolutely sound like a scam. Like, I am not going to, you're sort of like a partner in this business, except you don't actually own anything. All you have is permission to give me money at some point in the future. And if you pay me at that point, you will own part of this company, but you can't sell it until we go to this, den of vipers, the stock market, and, put the company in control of financial speculators. And then who knows what it'll be worth, but maybe it'll be a big number. If the stock market did not exist and were not like an institution people were familiar with, this would absolutely sound like a scam. This would sound like just someone is talking really fast and throwing out a bunch of technical terms in order to get you to work for less money than you're actually worth. And I think, Americans tend to just overestimate the general cultural salience of the stock market and of financial markets in general. And we are part of this Anglosphere culture that has more of a tradition of regular people taking a flyer on the stock market and participating in the financial system, for better or for worse. And the for worse part is, if you do have a system like that, then you have a system where there are fewer guardrails. Like, it's democratic in the positive system of lots of people can participate and prices are the result of this collective attempt to figure out what companies are worth. But it's also democratic in the more negative, like populist sense of, if everyone goes crazy in exactly the same way, which is the thing that people are prone to do, then valuations can swing massively in the wrong direction. And so the downside to the Anglosphere capital market centric approach is you get more frequent and more severe financial crises. They usually get cleaned up faster than they would in a more bank centric financial system, but it's unpleasant. So that's kind of the grand bargain of that system is, you are way more likely to get rich. You are also way more likely to get completely wiped out, but you will probably have another chance to try to get rich again. And in a system where people can lend and they can also sell those loans if they get nervous about the credit, and they can own equity and they can trade derivatives on that equity, it is just a lot easier to convince someone that the fact that you failed catastrophically before just means you're the kind of high variance person where it's worth owning the equity because the equity is equivalent to a call, like equity in a sufficiently early stage company is equivalent to a call option. Like it's a bet not just on the expected outcome, but on the variance of that outcome. And so if you can maximize variance, the equity is still worth something because there's that small chance of the 100x or 1000x return. So India has apparently inherited some of that, and I think they went through a weird path to get to a more capital market centric financial system. It's kind of hard to have that under socialism. You can have that in a country that calls itself socialist, but kind of isn't. There is such an institution as the Ho Chi Minh Stock Exchange. So if you're ever wondering which side actually won the Cold War, we have an answer. It's that. But India did go through this socialist phase, and then has had like this fitful transition to a more capital markets dominated economy, but has been just part of this Anglosphere culture and has absorbed some of those norms for a long time. I think it is a good idea to give credence to the linguistic ties, that if you have a country that has a substantial English speaking population and that is also exporting things in the service sector as well as the manufacturing sector, then you just have a lot of sort of cultural drift from other countries, and that includes adopting their norms on regulation and how you manage companies, how you set up a financial system, etc. And that again is there are definitely positive and negative trade-offs there. There was a paper a couple of years ago actually that was arguing that one of the things that holds India's economy back is that because there is an English-speaking elite, because they can go to schools in very rich Western countries, they will sometimes come back from that and try to implement rules that make a lot of sense at a GDP per capita of like 50,000, but do not make a lot of sense if it's an order of magnitude smaller. So things like banning plastic bags or being really nitpicky about recycling. Like in a country that is poor and has a low GDP per capita, they're simply not producing as much stuff. And so the pollution problem becomes a lot less important. It becomes a lot more important as you grow, but early on, it's not the main thing to optimize for. And there is definitely a time to care about it, and it's not when there are still people starving.
Speaking of India, China, or countries like it, you also wrote about how people think that a lot of jobs are going to be lost to AI, but maybe it's just good old globalization or outsourcing that'll get them first.
Yeah. So there was a company that announced that they were doing layoffs, and they were going to hire half of the headcount back, but in lower cost of living places. So it was a good reminder that there are just lots of reasons that jobs go away. And the net number of jobs added is a tiny fraction of the gross number of jobs added, because most of the time, most job creation is zero net job creation. It's one job went away, another job showed up. The person who lost one job got another job, or we all kind of shuffled human resources throughout the economy. And the number of jobs, it fluctuates around 95% of the number of people who are working. Sometimes 90% of them are employed, and we call that a very, very bad recession. And sometimes 96.5% of them are employed, and we're very worried about inflation, and should be, because that tends to be a pretty inflationary environment. But the number, like the employed people as a fraction of people who want to be employed, it fluctuates in a narrow range that looks a lot more dramatic if you rephrase it as an unemployment rate instead. And that is not to say that AI doesn't end up destroying some jobs. It very clearly does. But it also seems to be destroying jobs more in the sense of there were hypothetical customer service jobs that would have been added at growing companies, but now the AI agents can handle that. But the customer service people they had, and customer service is often a fairly high turnover job. So you can, attrition can solve what layoffs can't in a context like that. Or attrition can solve it almost as fast as layoffs and probably more cheaply. But what you will probably see is that for some of these companies, they accept slowly declining headcount in certain departments. They can outsource more of the work to AI, and their output stays pretty constant, even though headcount has gone down. And yes, the bill for the OpenAI or Anthropic bill has gone up, but not nearly as much as payroll has gone down. And I think one of the questions to ask is like, it's always hypothetically true that some technology will be the technology that finally just net destroys demand for labor. We haven't had one of those yet, and we've had a lot of very transformative technologies in the past, but it's not logically inconsistent for there to be some technology that does, in the aggregate, destroy jobs and doesn't replace them with other jobs. I tend to bet against that, just because that's the base rate, is like there has not been a technological transition that didn't freak people out about job losses. there really hasn't been one that didn't eliminate some jobs, but there also hasn't been one that didn't create more jobs than it eliminated. And you can definitely argue against that. There's the classic draft horse analogy where up until 1913, every technology that improved the efficiency of transporting goods over long distances also raised the demand for horses because you still had to do the last mile. And then at some point, the truck was a better deal than the horse, and horse populations peaked and never went up again. But there's still a lot of stuff where it's just annoying to deal with the AI models. Like, they are not that much. They enhance a lot of productivity more so than they replace a lot of jobs. And there's that temporary shift where you actually have higher demand for exactly the kind of labor that's being replaced by AI, because that demand comes from the fact that what those workers are doing, it used to be operating expenses, or used to be COGS. Now it's CapEx. Now it is you hire a customer service person to address every novel complaint, because every time they have an answer to that new complaint, the chatbot that's replacing them gets a little bit smarter. And if you know that chatbot is going to get really, really smart and is going to be able to handle all sorts of new configurations and new weird edge cases, then you probably do default to over investing in training and over investing in having human customer service agents who are providing that training data, because you know that at some point you could have model collapse. If the model does not have good answers to some set of questions and tries to produce those answers, and then that gets incorporated into its training data somehow, you can pollute the data pretty badly and run into serious problems. So you do want to sort of overinvest in the initial training, and that means overhiring exactly the jobs that are being destroyed by AI, but only for a while. So yeah, if you happen to work in customer service and you did manage to be in the lucky position where you got a raise because now you're producing valuable training data, like definitely try to develop other skills as quickly as you can, because you're getting paid well for a while, not forever.
Yeah, that makes sense. You also wrote about the energy transition happening in reverse.
Yeah, so I love cases where there is some economic trend that happened, and then you have some shift that causes it to happen in exactly the opposite direction. For example, when China first went communist, Mao at some point got really, really paranoid about Russia invading, and he decided that China would not be able to retain its productive capacity if Russia could capture big cities, get all the factories, and then maybe Russia manufactures the tanks and munitions instead of China. So they moved a lot of their manufacturing, especially for strategically important industries, into mountains and into out of the way places and things. And that meant that actually transporting stuff to and from factories was really expensive, and the factories were all really inconveniently located. And that meant that China actually had a ton of economic potential energy when they decided not to be so communist anymore, because you could 2x the productivity of a truck factory by moving it out of the mountains and just putting it somewhere that actually made sense. And so you have all these one-time gains from undoing dumb mistakes, and you're basically putting that factory right where a similar factory would have been 50 years before. But now you're doing it because you're undoing some previous mistake. On the energy side, what has been happening recently is that data center demand for energy is really high. It's very hard to get permits to build a brand new project in a place that was not producing power before. It's comparatively easier to get permission to either keep something producing for longer when you're going to shut it down, or take something that was shut down a few years ago and put it back in business. Sometimes these things get completely demolished. Sometimes there's just a semi-abandoned building somewhere. And so we're seeing some of that, and it's for better or for worse. So like coal has been a big culprit here, where this was actually part of, I think it was a part of the counter Bitcoin narrative a couple of years ago, was that there were coal power plants where they were scheduled for end of life in 2020, but then or scheduled for end of life in 2022. Bitcoin went up so much in 2021 that they actually kept producing for a while longer. But I think for data centers, it is like more arguably pro-social. Like, you don't have to be an AI fanatic to think this is fine. All you have to believe is that there is some substitution between energy intensive things that people do, such as driving to your therapist's office to have a therapy session. If that could be replaced with a conversation with an AI therapist that uses orders of magnitude less energy, then keeping that coal power plant running is actually the best thing for the climate. That's not the case for every single thing that AI does. Like sometimes, we just did not devote a lot of economic activity and energy output to creating weird AI art, or weird AI looking art in the past. We just didn't have as much demand for arbitrary art about random topics. But for some things, AI is actually a substitute for human activities that require more energy input. And so it is a net energy savings. But one of the other cases of the energy transition running in reverse that was really positive was nuclear. So 3 Mile Island is back in business. They are going to be back in business. Hopefully, we'll see. Some of the paperwork has not been filed yet from the last time I looked at this, but that is the kind of power that you really want for an application like this. Like it's very cheap. It doesn't vary very much, and so as long as you know roughly what the baseline demand will be, it is an extremely good deal. And I think that anything that keeps the nuclear industry alive a little bit longer is net good. Nuclear is very low emissions. It has been expensive in the past, but a lot of that is that we chose a path to making it more expensive. It did not actually have to go that way. And one of the things I worry about is that it's been long enough since 3 Mile Island, long enough since nuclear paranoia, that a lot of the people who really knew what they were doing in that space are retiring. And the upside of that is when an industry gets younger, it does tend to get more risk seeking. And the downside is they knew a lot about running nuclear power plants. And so you're actually destroying some societal wealth when someone they take early retirement because their power plant is being shut down. And when it gets turned on again, they're pretty comfortable with their retirement and not going to go back into the workforce. So I do worry that we are actually losing some of that tacit knowledge that we accumulated over many, many decades. But hopefully we'll keep some of it. Hopefully some people will stick around out of a love of glowing green energy, and they will transmit enough of that knowledge to the next generation that things work a little bit better.
I also want to get to something else you wrote about, which is how Forbes has an interesting business model where they do a lot of long tail content on very niche topics. And as someone who's in the business media game myself, I'm curious to better understand the strategy and what should we learn from it.
Yeah, it's kind of sad. So Forbes, when I first started getting interested in business, Forbes was just a pretty solid business magazine. They had the Forbes 400, they had lots of good profiles and lots of companies, they had interesting columnists, etc. But over time, what's happened is like they still have that brand and they're still associated with just wealth and how it's made. But they don't live up to it nearly as much as they used to. And one of their early brand extensions was this thing, the Forbes Contributor Network, which was basically you could sign up and you could post a blog, but it would be hosted on Forbes. And so you got to say you were quoted in Forbes or you contribute to Forbes, etc. That was basically the arbitrage. It was like Forbes knows that there are a bunch of people who like the brand name, want to be associated with it, and that not only will they write something, but they will send it to a bunch of people, and so that's more page views. They will link to it from their site, so that's more inbound links, which Google cares about, pays attention to, and it's sort of it's diluting the brand, but very gradually. But then what they have started doing more recently with this Forbes Marketplace thing is just mass producing pages about random niche topics. And because Forbes has so many inbound links, because it's such a recognizable brand name, these pages do tend to rank fairly well in Google. But these are not pages on topics that Forbes is the go-to resource for. These are just general topics like hiring an exterminator or, random cooking and healthcare and whatever related stuff. It is just a way for them to take the fact that their site has a lot of inbound links. It's been around for a long time. Google trusts it and basically abuse that trust. So I don't recommend following in their footsteps. I also don't think that model has very long to live because a lot of the questions that people are asking Google that would lead them to a page like this, people will just ask ChatGPT in the near future. So I think it is more of like an interesting consequence of a generally good system. Like it is generally good for search engines to pay attention to whether a given site is owned by a long established organization or whether it just got started. It's useful for search engines to pay attention to inbound links and to give sites credit for the fact that other people treat them as a trustworthy resource. But it also gives sites an incentive to continuously not live up to their reputation. And in fact, the more that they can preserve like this ideal gap between how good people think they are and how good they actually are, the more money they can make. I wrote about this a long time ago with respect to ratings agencies and accounting firms, where they both have exactly that incentive. Like the strong economic incentive that Moody's has is sell the fact that a triple A rating from Moody's means something to people who are really double A credits. And if they continuously do that, then initially that means it's a really, really profitable business. They're earning a lot of money from putting ratings on, say, CDOs backed by subprime mortgages. And eventually there's a lot of embarrassment, but that's in the distant unknown future, and the immediate revenue is available right now. And I don't think that there was any, cynical plan to do this. I don't think they took a vote in the boardroom and said, hey, we can convert our $10 billion brand name into $9 billion in free cash flow. And so let's do that. Let's zero out the brand and take the money and run. But I think that if you have a business that has a recognizable brand name and it's a brand that people trust, you have to have a lot of systems in place, because everyone at the company's economic incentive is to take advantage of that. And there's like a psychic incentive to do the opposite, and to say, like, I am so grateful to work for this amazing company that impresses everyone I know with my association with it, that I want to make the brand name even better. And there are people who genuinely feel that motivation and they want to make it better. But if you aren't careful, those people will tend not to get promoted quite as fast as people who could put up really, really good numbers by leveraging that brand name for all it's worth and eventually making it worthless.
So not much to learn.
I mean, I think the thing to learn is, like, you are looking at someone who is having a really, really good time because they really enjoy drunk driving, and they're 6 beers in and they just cracked open beer number 7. You don't know exactly how this will end. Maybe this is the night that they're lucky. Maybe this is the night that they're lucky enough to get pulled over and have some important rock bottom experience from that. And maybe this is the night that they just go off flying off somewhere, and that's the end. Like, you're seeing them at the point where they're having a really, really good time making really bad decisions. And so I guess that's really the lesson, is, like, pay close attention to what happens next, because what probably happens next is Google says, okay, this is really embarrassing to us. We are going to nuke Forbes for a while, and not only will they not get traffic on all their random long tail stuff that's just meant to supply page views to ads, but also, if you Google Forbes 400, maybe you'll find Forbes. But maybe if you Google, like, let's say you Google, I don't know, Elon Musk net worth, maybe last week you saw Forbes, this week you see Bloomberg, and maybe it's a while before Forbes gets back up in the ratings. And maybe by the time they do, other people's rich lists are actually more trusted, have more social currency, because you say the Forbes 400 to someone who is young, they have no idea what you're talking about, because Forbes is just not as culturally salient. And you say, that list of the richest people, and they say, oh, the Bloomberg list, right? So yeah, you can have cases where the search penalty actually makes it very hard to sustain the brand that was being exploited in a way that created the incentive to do the things that got penalized by the search engine. And then, yeah, what they end up with is they made some money, they got a lot of traffic. Now they are not in a position to get much traffic, not in a position to make much more money. And they could have made other choices that would have made the Forbes brand remain valuable for another couple decades.
Yeah. So Turpentine wants to start a publication, and one thing that we admire from Forbes is just the list format. Basically, they've got some popular lists. Whether it's I'm not as excited about the Forbes 30 to 30, but the sort of the Midas
list is good. Yeah.
Yeah, it's sort of the cloud, like, data, sector specific lists. And lists are a powerful medium, and it's funny how bad they are executed. Like, all the time AI 100 list had to do was just have Elon Musk on it and not have Scarlett Johansson or Scott Wiener on it or something. But yeah, it's kind of funny how much of a joke some of these things are. But these formats are very powerful. So my dream for the Turpentine publication is to have a mix of data stuff. By data, I mean more just like crowdsourced perspectives on what companies investors think are good, or what investors, founders think are good, or what products people think are good. Just sort of like wisdom of the crowds, pulsing people who are, who have some expertise. And then kind of like contributor led, almost like the Free Press, Barry Weiss's company, where in the beginning she just got influential people to write. The Players Tribune is not a perfect analogy because for a bunch of reasons, but that's a media company where the NBA players wrote the articles instead of like journalists. And there is some, I guess it's not a perfect analogy because they themselves can't really write, not to put NBA players down, but they're good at basketball.
They're selected for other traits, yes.
Yes. Whereas tech people can actually write and they have much more expertise than journalists. And so we're trying to get, insight. We do this with podcasting, but we'd like to do it as at a publication level. And it's been hard because none of these people, like you're one of the very few people who writes it at a very high level full time. But most of the people who have something to say do something else full time. So they don't have the time to write something daily, but maybe they can write something a quarter or something a month. And if we get enough of these people, maybe we can have something interesting. Anyway, so that's just a little bit of a update on what we're thinking at the moment.
Cool. No, I think there's probably room for, well, there is a lot of competition in tech media, and there's a lot of good competition. Like the information, I would not want to be competing directly with the information. I think they do a really, really good job. And I also think lists are just a really fun format. Like people genuinely enjoy them. They feel comprehensive, and there is something just crack like about continuing to run down this list. And this was like the Forbes 400 was a weird one because the experience of reading that, if you just read it in order, is you're just getting this constant bewildering mix of all the different things that people can, like all the different economic activities that can lead to someone making billions of dollars. If you read it by category, you get this more coherent view of the world where, maybe you sell this kind of software, maybe you sell that kind of software, maybe you sell hardware instead, maybe you distribute computers. Like it all kind of makes sense. It all kind of hangs together. But if you just read it in order and it's like, this person started a hedge fund. This person hauled garbage for a while, and they bought all the garbage hauling businesses and they took that public at the right time and sold at the right time, etc. This person built a lot of houses in LA in the 1950s and held on to some of the land, and what used to be next to the suburb is now in the middle of the city, etc. Like it is just this blunt way of hammering in that the economy is fractally complicated and it's very hard to figure out where the value accrues. So those kinds of lists are fun. And they're also fun as just this way to feel like you have a comprehensive understanding. So the original, like the first Forbes 400 list, by their admission later on, was not comprehensive. And for a while, the list had pretty high turnover because they just keep finding like obscure Mellons and Rockefellers and other rich families, and there were often new entrepreneurs showing up as well. Now it seems like there just aren't nearly as many obscure rich people. Maybe there are. I guess you would have no way to know, but I get the impression just from rarely hearing about someone who came out of nowhere and is suddenly rich, and where it isn't like the way that they came out of nowhere was their company went up tenfold in value because it was doing things that are obviously very valuable. We just have fewer cases where some unknown person turns out to be very, very well off. So that those lists do feel really comprehensive, but I think what you have to think about in terms of list products specifically is that the feeling people get from reading the list is that this is a comprehensive list. Like, when the 30 under 30 originally came out, the target audience was someone in their 50s. They realize their young friends are friends in their 40s. They don't know what the young people are up to, but they do know that some of these young people are doing interesting things. And 30 under 30 was like a way for them to all feel like, okay, I know who all the important 20 somethings are. And the problem though is that the list that gives you that feeling is not the actual list. Like the important people and the important feeling people are not going to be the same people. And so you would have to figure out to what extent you are giving people what they want to feel, and to what extent are you giving them the information that they believe they're asking for, because those will actually be two different things. And I think if you have a small company that is not designed for massive scaling, you can be true to yourself, you can be true to your brand, and it works well. And in my experience, like producing the kind of content that you want to consume, or writing the things you want to read is the actual way to say that in normal human language. That does work out. But it is not the revenue maximizing thing to do in any given year. It's not the growth maximizing thing to do. But what it does is it lets you accumulate the intangible value. It lets you actually have a brand that is valuable and that is worth something. Like it's valuable to people whose opinions are sophisticated and well informed, etc. And you can usually find things to do with that brand. You can usually find ways to monetize it. And also monetize it in ways that are true to the brand and contribute to it, and not like, I built up this big intangible asset and I'm going to burn it down and convert it into a little bit of money as a waste product.
Totally. Yeah, I don't want to compete with the information either on scoops and reporting. What I'm interested in more is like company breakdowns of like, if I want to know how Replit makes money or how's it doing, or just kind of the details of how these companies actually work, as opposed to separate from who led their round or what scandals happening in the company. I think information does kind of news at scale, but people like you and Ben Thompson, I feel like, do analysis, and I think there's just greater opportunity for analysis, especially private companies.
Yeah, I would absolutely cop to that. And yeah, there are more private companies than Ben and I can write about, and there are more companies all the time. So yeah, there's definitely room. And I think that's also one of the nice things about being a smaller media entity that is not trying to become the biggest media entity, is that I can view other people who are adjacent to me or even doing the same thing as me as complementary goods rather than as direct competitors. Like they're, the takes are going to be sufficiently different, and the focus will be different, and the narrative that we apply to our takes will be sufficiently different that there's some level of competition. Like there are people who have a finite amount of time to read. They're going to spend 10 minutes on one newsletter, and it's one of these five. And so there's competition for that. But then there are a lot of other people where they're subscribing to a bunch of stuff. They're not reading everything. They are looking at headlines and seeing what they should read. And they, in that case, there is sort of like a dialogue that is happening that they're listening in on and participating in. And it's less choosing which monologue to focus 100% of your attention on all the time.
Yeah, it is interesting with people like, you and Ben. The sort of readers are like, I have to get the Byrne take on this, or I have to get the Ben take on this. Where if it's like a faceless brand, it's a little bit different. Like I have to get the free press take on this. It's like, oh, do I like this writer? But you don't know where you're going to get necessarily, or do I like this topic? But yeah, pros and cons. Anyways, we're at time, so I want to be mindful. This was another great conversation, Byrne, as always. Until next time.
Until next time. See ya.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.